let everybody in.
All right.
Welcome, everyone. We've got about another minute or so. We'll let the few of the late folks that might be a little bit late, but welcome. We appreciate you joining us for this session. In a minute, I will introduce you to Jennifer. A few more people coming in. Yeah, perfect. Make sure everybody's on mute. Looks like they are. If you're not already, perfect. Well, welcome everyone. We appreciate you participating in this this particular session. We want to welcome Jennifer Tsyn with Bond, Schoeneck and King. She is an attorney with them and has a varied liquor licensing practice and has represented hotels, restaurants, sports stadiums, performing arts arenas, colleges, universities, bars, breweries, clubs, and other businesses in obtaining liquor licenses and permits, and has also been involved in disciplinary proceedings. We're very fortunate to have her with us today to talk about crowdsourcing and adding other investors, which I know is super important. I think for this presentation, if you all could enter your questions into the chat, that would be great. Jennifer, you're okay with taking questions during, correct?
Absolutely.
Yeah, so please, everybody, don't be shy, ask questions. And then what we'll do is I'll call you out for your question, or if one catches Jennifer's eye at one point, then we'll have you unmute yourself and ask the questions, because sometimes we know that these things can get sort of, if you don't understand something, make sure you ask the question. So without further ado, Jennifer, thank you for joining us. Take it away.
Great. Yeah. Thank you for having me, and thank you everyone for joining. Hopefully can give you some useful information. You'll see I've got the PowerPoint up on the screen, and I know people don't love PowerPoints, but I did want to have one to sort of walk us through some useful information. I don't want to get too deep into the weeds on any of this. I know that, securities and other rules are not maybe all that exciting to, in some circumstances, but I do want to give you some information that I think will be really useful. So my goal today is sort of take you through what we would talk about if you came into my office to sit down and talk to me about bringing in a new investor into your business that has a liquor license. I've been doing liquor licensing for 17 years now. Also do a lot of corporate transactional work. So I find that, those areas actually fit together a little bit better than you'd think. So wanted to sort of take you through what I think you should be thinking about right up front if you want to bring in some new investors, whether it's through crowdsourcing or some other way. Give you a little overview of what the rules are that are going to sort of structure how you can do that. And also touch on some things you should be working through as you bring in new investors about how your relationship with them is going to work going forward. And yes, absolutely. Any questions, feel free to reach out, and Paul will tell me if I don't see the chat as I'm sort of going through this. And I left time at the end for questions as well. All right. Oh, bear with me one sec when we get the PowerPoint going. There we go. So what we're going to cover, what we just talked about. Lots of different reasons you may want to bring in new investors and lots of different ways to do it. So I want to talk a little bit about those strategies and just sort of stress right up front. No two situations are ever going to be alike. In all the years I've been doing this, every deal is different. Even if you're in the same industry in two different breweries, your needs are going to be different. The way we structure it may be different. But these will hopefully give you some basics to help you think about how you might want to do this going forward. There we go. So reasons to bring in new investors. Obviously, the top one is going to be to raise capital. Lots of reasons you may want to be doing that. And the reasons you may want new capital, those reasons may help structure how we do this. If it's an immediate need versus wanting to bring in a new investor because you want to expand, or you need a new piece of equipment versus the next one, attracting key talents. Might as well get a call as well. This is great brewmaster. I really want to bring them in, but I want them to have a piece of the business. I want them to be invested with us and working with us to grow. So those situations are going to be different. The needs of the person coming in are going to be different, and your needs are going to be different. Sometimes it's new management. You are thinking about your next step in life. Maybe you want to take a step back from day to day. Maybe you're thinking of retiring. Maybe there's other reasons you want to get some other folks in to help you run the business. And sometimes it's rewarding current employees. You've got I know your employees are just the backbone of your business in a lot of ways. And to get them more invested in your success and in growing the business, that's another reason you might want to bring in some folks, including them or some others. So if you came in to meet with me and we sat down and we talked about bringing in some new investors, the very first thing we might talk about is, what is your current situation? This sounds basic, but making sure you have your current situation well in hand and you know exactly how you're set up right now is very important for how we might structure and bring in new folks. So if you are thinking about bringing in new investors, I would suggest you get out that file of the old things that you did, the old materials you have from when you first started, and make sure what you've got and what you might still need. So obviously you've got your permits and your licenses, pull them out, take a look at them, make sure you've got them, your numbers, your classification of license, microbrewer, brewer, farm brewer. Make sure you have all of that sort of set to go. Now, I'm going to assume that your licenses are probably in the name of an entity. That's what we usually recommend. If not, if they're in your personal name, that would be sort of a preliminary step we'd have to work on. But I'm going to assume for purposes of this discussion, you've got an entity in place, whether it's a corporation or an LLC, that's set, and that's how your permits are issued. If you are a corporation, time to go back and check, make sure if you're an S Corp or a C Corp. Again, those things are going to kind of matter as we go forward and you think about bringing in some new investors. So again, focusing on how you are set up right now. If you're a corporation and you're thinking about bringing in new investors, the first thing I would say is also pull out that minute book and that stock ledger that you probably got when you worked with somebody like me to form your entity way back when. And you probably put it on your shelf and you haven't looked at it since, which is completely common. But now's the time to pull that out. Take a look through it. Confirm how you have your shares. Sometimes I've had clients come to me and say, well, there's two shareholders, we're 50-50. But are you? Did you do 51-49? Are they exactly 50-50? Now's the time to double check that. Look at your bylaws, make sure you have them, and see if there are any of these sort of special things that we might have put in your bylaws back at the time we formed this. A lot of times when I start working with a client right up front and we're talking about how to structure their corporation because they want to apply for a liquor license, we may talk about these sort of things. There may be classifications of stock. Is it all common stock? Do you have any preferred stock? Do we limit anybody's voting rights or give anybody preferred voting rights? Sometimes if you've got two shareholders, but one was bringing in more money, they might have certain preferred rights that you'd want to, maybe you've never used them because things have been going so great, but now's the time to go back and double check and make sure what you might have agreed to back then. Who are your directors? Have you been electing them and updating that board? Again, not the end of the world if you haven't. It's very common that you haven't, but if you haven't and you're thinking about bringing in investors, now is the time to get those things up to date and make sure everything is the way it should be. Have you been holding shareholders meetings? And this is a big one. Did you sign any shareholders agreements from the time when you formed your entity? Do you have any sort of written agreements between your current owners right now? That's an important thing to look at and double check. So if you're an LLC, similar kinds of questions. Who are your members? And did you issue membership certificates? Or is it just that your members are reflected in your operating agreement? that's the case, is your operating agreement list all your members, and does it list the correct percentages? Again, that's another thing that's very common. I'll help a client set up an LLC because they're going to apply for business, get them this operating agreement, which is the written agreement that helps you control how you're going to operate and what things each of you can vote on. And sometimes I'll get it to them with the names and they haven't fully decided yet. Is it going to be 49-51? Is it going to be 40-60, 50-50? And then sometimes they don't go through and then finish filling that out. So that's something that you'll want to make sure is in good shape. You also want to check and see if there's any different classes of members, any limits on voting. Do you have units or membership percentages? Again, you just want to make sure that you have a really good grasp on how you're set up right now. And do you have a board of managers or a single manager? If you don't, are you holding member meetings to make these big decisions? So all those things, sort of a preliminary step, but good to have all set and cleaned up and ready to go if you're going to be bringing in new investors. So next I would ask about, are your records with TTB and the Liquor Authority up to date? Again, this is very common. Client comes to me, they're thinking of selling, they're thinking of bringing a new investor, they're thinking of expanding, they're thinking of doing a big transaction that's very important for their business, but they haven't kept everything up to date with the TTB or with the Liquor Authority. So if that's the case, now it might be the time to come talk to somebody about getting that cleaned up. We can sometimes wrap that sort of into your transaction that you'll be doing, which is great. But anytime you're going to be bringing in new investors, you're going to be giving them a lot of information. They're going to be doing due diligence. And that's kind of one of the things we'll be talking about is what do you have to tell new investors? However we structure this, those new investors are going to have questions. They're going to want to see that you're in compliance with a lot of different things. So if you're not, now's the time to start thinking about what we need to do to get you into compliance. So determine what you will need. So bear with me one sec. We're having a little electrical issue. Hang on one moment. Bear with me. Thank you so much. I was telling Paul before we got on that, yes, I'm having a little bit of issue with the lights in this room. So thank you for your patience there. So determine what you will need. Obviously, you probably want to bring in new capital, right? That's the main reason where we'd be talking about this today. But how much do you need? How much are you looking to raise? And when do you need it by? So the amount and the timing may play a big part in how we structure this about bringing in new investors. Are you looking for any services from those folks? Obviously, if you're doing crowdsourcing, no, you're not going to be looking for those, multiple investors to be giving you any kind of services. But if you're bringing in just one or two other folks, are you looking for them to do anything other than bring in the cash? So that's important to think about. We talked about sometimes you'd be looking to reward current employees. And a lot of how you would structure this is going to depend on where are these investors coming from. Have you been approached by somebody, maybe an angel investor you've been talking to? Has somebody come to you? So you already have somebody in mind that you'd want to bring in, or maybe a friend, a family member, somebody like that. If not, and you just have the interest in bringing in investors, but you don't have anybody particular in mind, how do you plan on reaching those folks? Do you have a network? Would you be reaching out to people? Do you think you might know some people? Or would you be looking to really do social media reach out? How did you see those folks coming in and talking to you about your business? So determine what you are and are not comfortable with. This is a big one that I like to talk about right off the bat. One of the first couple times we talk, what is going to be important to you? It's your business. You've been, this is something maybe you've grown from the ground up. It's obviously very important to you. How much control are you really looking to keep versus how much control are you comfortable letting an investor have? How much say do you think the investor should have in the business? Are you okay with them having a vote? Are they going to want to have any say in day-to-day control? So even before you really sit down with that investor, I'd like to tell people to start thinking about what you want and what you would become. What are the limits of what you would be comfortable with? Are you going to continue to work every day in the business? Or do you think, they might want to bring in some of their own people? Also something to think about. And angel investors and venture capitalists are going to have significantly needs and requirements than family or friends. So something to think about and just be aware of right up front. So the next thing I ask about your current owners, are you looking to stay in or cash out? A lot of times it's, obviously you want to stay in, you're going to keep owning a share of the business. But sometimes, I get clients who say, yeah, I'm looking to take a step back, or I'm looking to sell. I'm really looking to sell. I'm really looking to take just a minority ownership interest at this point. I want to sell. So again, something to be aware of and may have a big impact on how we structure things going forward. Are you looking to issue new ownership shares to folks, these new investors coming in, and thereby diluting your percentage of ownership? Or were you going to sell a part of what you have to give to these new investors? So also going to make a big difference. And things to think about: whether the current owners have any preferred rights, non-dilution, right of first refusal. If you originally or at some point in the history of your business brought in an angel investor or a venture capitalist, they probably have some of these things. So something to be very aware of. A lot of times we'll set it up so that if you're the founder of the business, you may have certain rights of first refusal or other rights to participate if new shares are being if offered to somebody else. So again, something to make sure we've got a good handle on before we do anything else. So after we would have sat down and gone through all of those things, the next thing I would do with you is start discussing possible structures for a transaction. And there's lots of different options. So the three big ones that we'll cover today are private placements, private tender offers or individually negotiated transactions, and crowdfunding. And we'll touch on each of them, talk a little bit about the rules for each of them. I mean, we could sit here all day and talk about the rules, which I won't do to you, but want to give you an overview of each of those so you can kind of see what they are, how they work, and if it might be something that's right for you or not. And which option we eventually go with has lots of different factors. Financial and accounting factors, what is going to work for your particular business. Tax, nobody likes to hear about tax, but tax is going to be a big part of any of these kinds of things. The needs of the business, how much you're looking to raise, when you need to raise it by, the size of the offering, and the types of investors participating. Like we said, are we talking about angel investors? Are we talking about crowdfunding, where you think there's going to be a number of investors who just bring in a little bit? Is it a family member or a friend? All of those things are going to play into what we eventually do. So, securities laws. Like I said, I'm not going to get too deep into the weeds, hopefully, on any of these, but these two key federal laws, the Securities Act and the Exchange Act, passed back in the 1930s, and they are the sort of framework of what you can and can't do in bringing in new investors. Passed back in the 30s, obviously there's been lots of amendments and changes and new laws. You've probably heard about, Sarbanes-Oxley, Dodd-Frank, but those key tenets from the 30s they're still in play. And those two laws, they regulate the registration and public sale of securities. They require companies to provide investors with information about the business, financial condition, and the results of operations. So that's going to be a big part of any sort of transaction where you're bringing in new investors. Even if it's something that's a little bit outside of these rules, and we'll talk about that a little bit, those investors are going to need that information, whoever they are. You're going to need to provide information about the business, your financial condition, and the results of operations. And those are sort of the key three things that the federal law is going to require. There we go. So what is the sale of a security? Why do we even have to talk about these rules? You may say, well, I'm a small business. I'm not looking to, trade my shares on NASDAQ or the stock exchange. Why do we have to worry about these rules? They are very broad. So many type of investments are the sale of securities, even if you wouldn't think of them that way. Securities include common stock, preferred stock, partnership interests, LLC membership interests, warrants, options. A lot of those things are going to be the sale of securities, even if you wouldn't normally think of them that way. But for the purposes of these rules, what is not a sale of securities? Borrowing money. So, if you came to me and said, I'm borrowing from a bank, we'd be having a totally different conversation. Issuing promissory notes or commercial paper, generally speaking, not a sale of securities. And again, generally speaking, and I'm going to say that a lot during this presentation because each one of these rules has about 100 exceptions. But generally speaking, offering securities, whether it's stock or membership interest, to one of the founders of the company, generally not a sale of securities. So if you came to me and say, hey, there's two of us, one of us wants to, we started this business together, one of us wants to give an infusion of cash, and so we want to adjust our stock percentages, that's a different call. So generally speaking, though, issuing stock or membership interest, if you're an LLC, in connection with investment is probably going to be a sale of securities. So that's why these rules matter. So can you offer a security for sale, right? So you want to bring an investor, you want to offer a security for sale, can you do it? The general rule is that you cannot offer securities for sale unless, and here's the big unless, this is mostly what we're going to be talking about, unless either you register that offering with the Securities and Exchange Commission, the SEC, and that involves filing a registration statement, including a prospectus, probably maybe seen some of those, or an exemption is available. That's a big part of what we're going to be talking about. So these exemptions allow you to do the things that I'm going to talk about, the private placements, the crowdfunding, et cetera. But one thing to be aware of, even if you fall into one of these exemptions and we do everything exactly right, and you structure your transaction perfectly so that it falls into what the exemption allows, you still can be liable for fraud under the Exchange Act. So that is why a lot of what we're going to talk about is giving disclosure to your investors, making sure that it's accurate, making sure it's complete. Because if it's not, even if you've structured it perfectly to fit into one of these exemptions, you could still have a problem. So risks if you violate these laws. Buyer might be able to rescind the purchase. So that is just a nightmare scenario, right? You've brought in a new investor, they've given you an influx of cash, something goes wrong, they can rescind their purchase. Now what do you do? Injunctions, cease and desist, a court could get involved. And anti-fraud claims, those things we just talked about. If your disclosure was not sufficient, if you made a misstatement or you left something out, made a material omission, and the investor loses money, something goes wrong, investor loses money, if they can tie that back to something you should have told them and you didn't, they might be able to recover from you monetary damages. So we just talked about to sell the securities, you got to either register or fall into an exemption. You're not going to want to register. You generally speaking, not going to want to do a public offering. That is a huge undertaking. Involves registration with the SEC, underwriters. It's very expensive, very hard, time consuming. So for the purposes of most of us on this call, I would think that's not the way you're going to want to go. So what we would do then is sit down and talk about how to make your sale of securities, bringing in your investors here, fit into one of those exemptions. And those are three we've just touched base on: private placements, private tender offers, or crowdfunding. And those are the big three we'll talk about. So private placements, what are those? You've probably heard about those. Lots of different kinds. Very pervasive. A lot of people do them. And there's lots of different ways to structure them. But the big thing is you are the issuer in terms of the rules that we're going to talk about. You're doing it directly. You're not using an underwriter. You're not using a portal. You're not using an intermediary. You're selling the shares directly. Now, there's lots of different kinds of private placements. The most common one is called a Regulation D, safe harbor private placement. Lots of different kinds though. But like I said, I don't want to bore you all to death with all of the rules. We'll just touch a little bit about how this particular kind of private placement works. But in the end, what kind of private placement you might do is going to depend on how much you want to raise, because there are different limits, and how many investors you want to bring in. And if they're accredited investors, you've probably heard that term, and I'll define that in a minute. But there's lots of different kinds. We'll talk about Regulation D. And one thing I like to tell people right up front is, you hear private placement. Okay, private, it's private sale. I don't have to file anything with the SEC, right? Well, you still do. It's not nearly as hard or as onerous as if you were filing a registration statement and prospectus, but you still do need to file something. So in a private placement, you can offer stock or membership interests in your business to multiple people. But you're going to have to worry about if those people are mostly or only accredited investors, which we'll define in a second. And in private placements, you may not be able to do general advertising or solicitation. Generally, no. There are a few ways you can. Like I said, I don't want to get into the 100 different, exceptions to each one of these rules. But generally speaking, advertising and general solicitation isn't going to work in a private placement, generally speaking. So that would mean you would have to have what the SEC calls a pre-existing substantive relationship between your company and the investor. So if you came in and said, I don't have anybody in mind, I've reached out to friends, family, I've reached out to my network, I don't have anybody, I really need to go find people maybe through social media, well, then this one isn't going to work for you. If you come to me and say, I've got a couple people that I know, or maybe customers, maybe they're partners I work with, they're friends, family, then, this might work for you. And one thing to just keep in mind is that buyers are going to have a limited ability to resell their securities after they get them from you. And that's going to be the case in most of these things we're going to talk about today, right? Doesn't mean they can never, but there are rules about when and how they can sell, because they're restricted securities, they're called, because you haven't done an offering statement. Okay. So, well, if you can also see me, I'm just going to let that light go. Can you also see me? Okay. So we're going to just keep going. I was telling Paul, we have energy saver lights in here, and I'm very short, and sometimes they don't recognize that I'm still in the room. So we'll just keep going.
We can see you. You look good. It's all good.
All right. So private placements. Done without the SEC registration that we talked about, but you do still need to do what's called a private placement memorandum, PPM. You don't file it with the SEC, but you do need to give it to your potential investors. And it's quite a bit of things you still have to put in it. The focus of that is disclosure, right? You're not registering it with the SEC, but you do have to disclose a lot of different things in it. Description of your business, well, that one's basic. Description of the offering. How much are you offering? How much are you trying to raise? What are the terms of what these people are going to be getting? Description of management. Who is in charge? How are you operating? Financial statements. Unfortunately, for pretty much everything we're going to talk about today, you're going to have financial statements. Whether they're reviewed, whether they're audited, whether it's just tax records, different offerings require different things, but you are going to have to give financials. A PPM also has what's called an MD&A, management's discussion and analysis of financial condition and results of operations. So it is pretty involved that you'll have to provide. You also have to give information about the principal shareholders and risk factors. That's a tough one because, right, this PPM is, you want to give it to investors, but it has sort of competing goals. You want to use it to sell your business, right? Sell in the sense that you want to get investors excited about your business and comfortable with what you're doing and excited to invest. But at the same time, you need to protect yourself. You need to include a lot of things, including risk factors. So it does have these competing goals. But as a general sense, you're going to have to disclose a lot of things in it. Almost everything that you would in a prospectus. And that's because I think I touched before on the fact that the anti-fraud provisions in the law are the same, whether you're doing a full registered offering or a private placement or crowdfunding. You still have to worry about these anti-fraud rules. All right. So like I said, when you're doing private placement, and actually this is going to matter too when we start talking about crowdfunding in a couple minutes, you may have to worry about the folks, are they accredited investors or not? So what is an accredited investor? You've probably heard that term before. So if we're talking about a natural person, an individual, an accredited investor is anyone who has earned income that exceeded $200,000 or $300,000 with their spouse in each of the prior 2 years, and they reasonably expect the same for the current year. Well, that's one way they could meet this accredited investor threshold. The other way is having a net worth over $1 million, either alone or with their spouse, but there's a number of things you exclude, and one of those is the value of the person's primary residence. So accredited investors, if you're talking about a trust, it's a trust that has assets over 5 million, and it was not formed specifically to purchase these securities. And the purchase is directed by a sophisticated person. If we're talking about an entity, is the entity an accredited investor? If that entity has, each of the equity owners are accredited investors. So sometimes you see if you've got like a group of angel investors that come together, form an LLC, that's when this generally comes into play. And what is a sophisticated person? That means the person controlling this has, or you have reasonable reason to believe that they have sufficient knowledge and experience in financial and business matters to evaluate the merits and risks of the proposed investment. So that's a little bit about what is an accredited investor. So one more thing to keep in mind, and unfortunately this is going to come up for each of the things we're talking about. So we talked a little bit about what are the federal rules. Each state has its own rules, and you probably still have to worry about those too. Each state has its own laws regarding offering and sale of securities that you may have to comply with. That's on top of complying with the federal rules. See, the federal rules focus on registration and disclosure, but the state rules can get into the fairness of the offering. So it's a whole nother level. Even if you do a Regulation D private placement, you still may have to make certain notice filings and pay state fees to sell to the investors in that state. So if you're selling to investors outside of New York, we're going to have more than one state that you have to worry about. And it depends on how you structure the transaction and where your investors live. So New York, right? I'm going to not get into all the other states because we'd be here all day, but we'll touch base quickly about New York. Another one of these old laws, it's been around a long time. The Martin Act, been around since 1921, and it's been, things have changed obviously over the years, but it applies to the offer, sale, and purchase of securities and commodities within New York State. And it gives the Attorney General broad powers to conduct investigations as far as sale of securities in New York. So fortunately for everybody on this call, they actually updated this a little bit back in December 1st. New York Attorney General adopted some regulatory amendments to modernize the filing requirements of this, particularly with respect to offerings under Regulation D, what we just talked about. And I won't read the whole thing. You can see it here if you're interested, but it makes it a little easier. You don't have to file the 9-9 in the same way. You can do this electronic filing instead. So one thing that makes a little easier for you. So quick summary, we just talked about private placements can still be expensive. Probably can't do general solicitation. And you have to worry about whether the folks you're selling to are accredited investors or not. And you may still have some blue sky laws to worry about. All right, so moving on, crowdfunding. I know there's been some interest in this, with the rise of social media. I know a lot of folks probably on this call are very tapped into social media. There's a big interest, I would say, in crowdfunding. How do you do it? How does it work? What can I do? What can I not do? So in its basic sense, crowdfunding involves the use of the internet and, hang on. There we go. Involves the use of the internet and social media to raise capital, generally from a large number of people, but in small amounts. So this is a new type of registration exemption under Section 4 of the Securities Act. called regulation crowdfunding. So crowdfunding can mean a lot of different things. What I'm going to be talking about is this regulation crowdfunding that's allowed under this exemption from the securities laws. And sometimes people say, well, you're saying these are a lot of rules. Kickstarter doesn't necessarily do it that way. Kickstarter and some of those other companies sometimes get around these rules by not treating it as a sale of securities. So they may treat it as like a donation or a prepayment. I've seen a sort of a payment for a reward, like you get your name listed in the credits if you donate to somebody's movie or something like that. So that's a little different. What we're talking about is this regulation crowdfunding where you are selling a piece of your ownership in your business. So generally speaking, this regulation crowdfunding limits the total amount of securities sold by an issuer to all investors. Right now, the limit is $1,070,000 in a 12-month period. That may be increasing, which we'll talk about in a second. But right now, that's how much it is. And that is, crowdfunding is still illegal unless you either register the offering with the SEC or your offering fits within one of these exemptions from registration that we'll talk about. Crowdfunding also limits the amount that each person can invest, right? So that's why it usually ends up working a number of people giving small amounts. So for right now, with individuals with an income or net worth of less than $107,000, the maximum amount that they can invest is $2,200 or the lesser of the 5% of the investor's annual income or net worth. If the investor has an annual income and net worth of at least $107,000, the maximum investment is 10% of the lesser of their annual income, not to exceed $107,000, or net worth $107,000. So a lot of rules to look there, but basically there is a maximum amount that each of these folks is going to be able to invest. And if the investor is a business, you calculate these rules based on revenue and net assets. So how does the process work? Basically speaking, crowdfunding, regulation crowdfunding that we're talking about has to be conducted through a registered broker-dealer or a funding portal registered with the SEC. So that's usually how it works. You go through a portal platform, and then the platform permits public access to information about the offering, and it allows sharing among the crowd of potential investors. So if this is something you're interested in doing, after you've talked to folks, you figured out what you need, what your situation is, the next step I would say would be to start finding a registered portal that you want to work with. Look into them, check them out, find out how their fee structure works. And most of them then have you create a profile within the portal. And then they would work with you to help you structure the offering and set targets. So sometimes I've seen portals will help you reach out to folks you know first to kind of put some feelers out to see if you've got some potential investors that may want to start making a commitment to invest. Sometimes the portal will hold those funds in escrow for you. And then once you've started working with your portal, you're going to find out what kind of solicitation you can do, right? Because there's different, even within crowdfunding, there's different ways you can structure this. So that's a big thing you're going to want to talk to the portal about. What and how they're going to help you get the word out about your offering. And mostly, I would say that the portal's probably going to be verifying these folks for you to see if they are accredited investors or not. But that's something you're going to want to talk about with the portal right up front. Are they going to be monitoring that? Are they going to be monitoring the individual investor limits? Those are all things that you're going to need to work with the portal on. And even in crowdfunding, you have to file something. And in the case of crowdfunding, it's called a Form C offering statement. And here's just a few of the things that need to be in it. A list of officers and directors, information on holders of more than 20% of your stock, business plan. How are you going to use the proceeds? The target offering amount and how long, what is the deadline you're going to set to reach that? How can investors cancel an investment commitment before they give you the money if they need to? What is the offering price? How are you valuing your shares? How did you come up with this offering price? What is your current ownership and capital structure? And also some information on the portal, the intermediary. So what else needs to go with this Form C? And when do you have to have it by? So you need to have the offering statement and your financial statements, generally speaking, before you can have offers, before you can accept any investment commitments. So currently right now, if your offering is less than $107,000, so a smaller sized offering under $107,000, you don't have to get full financial statements, but you have to have certain financial statements, right? You have to have GAAP financial statements, and it can be certified by your principal executive officer. If your offering is between $107,000 and $535,000 within a 12-month period, then you need reviewed financial statements. So step up from that. If you're looking to raise over $535,000, then you need to go all the way and get audited financial statements. And generally speaking, under this regulation crowdfunding, you can't sell any of your shares until after the information in your offering statement is publicly available for at least 21 days. So advertising, what and how can you advertise? Regulation crowdfunding does allow you to advertise, generally speaking, does allow you to advertise the offering through a notice containing certain specific limited information that will then direct these potential investors to the portal where they can get more information, right? So, and then you can communicate with investors or potential investors on the portal's platform. And that's where you'll have more ability to answer questions about the offering. But prior to commencing a crowdfunding offering and filing the Form C, you can disseminate a little bit of information, right? You can, and I'm going to reiterate because this is for language from the SEC, information that does not constitute an offer of securities. So things like factual business information, things that do not condition the public mind or arouse public interest in a securities offering. So I know that definition's not all that helpful. That's something you could, would want to talk to an attorney or the portal about. What can you and can't you say? But generally speaking, the SEC makes a big distinction between communications that include the terms of the offering and those that don't. Are you just telling people to go to the portal and find out more information, or are you really getting into the nuts and bolts of the offering? So Expedited Rules. Back in May of 2020, the SEC issued some rules to expedite the offering process for eligible companies by providing relief from certain rules about timing and what financial statements you have to have when. To hopefully, with the intent being to make things a little easier, a little quicker for companies that were struggling, particularly during the pandemic, to raise money. So to take advantage of those temporary rules, you had to meet certain enhanced eligibility requirements. You had to be in operation for at least 6 months. And if it's not your first crowdfunding, there's certain things you had to have done previously. I won't get into all the nitty-gritty rules of those, but those are the big things. So under these expedited COVID-19 rules, offers can be permitted if you have your offering statement, but you don't yet have your financials. You can start getting some offers, but you can't accept investment commitments until you have those financials available. And that was done because obvious reasons, particularly during the pandemic, it was hard sometimes to get your financials in time. If you're offering more than 107,000, but not more than 250,000, you could use, instead of the reviewed financial statements, which you were generally required to get from your accountant, these temporary rules would allow you to use certain information from your federal income tax return certified by the principal executive officer. So make a little bit easier for those folks looking for less, to bring in less than 250,000. And instead of having to wait the full 21 days, we talked about how the offering statement things had to be public for 21 days before you could start getting commitments. Under these COVID rules, you'd be allowed to have sales as soon as you had received binding investment commitments up to the target amount. So that could be before the 21 days had run out. So shave a little bit of the time off that you'd have to wait. Now, those rules were set to expire, but there we go. On November 2nd, the SEC adopted more new rules, and they were set to take effect on March 15th. So a lot of these things we're talking about are in flux, right? So those proposed rules that were supposed to take effect on March 15th, we're going to increase the total amount you could bring in under crowdfunding from $1,070,000 up to $5 million. It was going to remove investment limits for accredited investors. We're going to use the greater of income or net worth when you're calculating the investment limits for non-accredited investors. So to make things a little easier, those folks could bring in potentially a little bit more. And it was going to extend those COVID-19 rules that we just talked about for 18 months. But we're not 100% sure what's going to happen now. It does look like the 18-month extension for those COVID rules, that is going to happen. That is happening. But the other rules, such as increasing the limit up to 5 million, that's unclear if that's going to happen or not, because when the new administration came in, they did place a certain regulatory hold on a lot of different things while they evaluated. So that's a little bit in flux. We're not exactly sure what's going to happen with that. So one also thing to keep in mind as far as the crowdfunding, blue sky laws, still have to worry about them, but they're a little bit easier if you're doing crowdfunding. States cannot use their own blue sky laws to require a filing or a fee, unless the state is the issuer's place of business. So here, even if you do crowdfunding, you still have to worry about New York. Or the state is a state in which purchasers of 50% or more of the offering are from. So if for some reason you were right on the border and 50% of your investors just so happen to come from the other state, then you'd still have to worry about that state's laws. So just a quick recap, summary of crowdfunding. If you want to get in a lot of investors, it's worth seeing if you can fit into this exemption. It can still be burdensome. And you do need to use a registered funder portal or broker. So that's a big one. So last one we're going to talk about, private tender offer, individually negotiated transaction. This can be used if you've got just a few new investors. Maybe they've come to you or their family, their friends, maybe it's an angel investor, but it's just a few. And we might be able to fit you in under this. Private tender offer is where the existing stockholders or members transfer some of their ownership interest to the new investors, or an individually negotiated deal where you're just issuing them some new shares. But you're gonna have to know these folks, right? You're not gonna be able to do general solicitation. You're not gonna be able to use really social media to bring these folks in. Could be angel investors or VCs that you'd be doing this kind of deal. So we still need to worry about security rules. We still need to make sure we're not running afoul of any of those. We still need to give due diligence, disclosure to these folks, and papering the deal. So you're still going to need to do, generally speaking, an offering memorandum and a subscription agreement. It's a little bit easier than the things we just talked about, the PPMs, the crowdfunding, things you have to do, but you still have to do something, even in this kind of deal. So hopefully I didn't put everybody to sleep. That's a little overview of the different ways you can structure it. So once you've thought those through, see which ones might work for you, then you start thinking about, okay, maybe I've got my investors in mind. What do those investors want? What are they looking for? Now I know kind of how I want to structure it. What are these investors wanting? How much cash are they looking to provide? Are you looking for anything else from them? Any kind of services, anything like that? And what voting rights do they want? And that's a big one. You come in with an angel investor, they're going to want voting rights. They're going to want certain ability. For example, if you've got a board, they may want a seat on your board of directors. They may want to say in things. So you've got to make sure you understand what rights you're giving them and how they can affect your business going forward after you've finished this investment. What exit strategy are they looking for? We talked about these are going to be restricted securities. So they're going to have a limited ability to resell these, so that's a problem for them. They're going to want some sort of exit strategy. They're going to, distributions are great and they're going to be happy to share in the success of your business, but they may not want to hold these for 20 years. They're going to want some ability to cash out at some point. What are they looking for? How do they see that happening? They may want the ability to sell those shares back to the company at a certain period of time upon a certain event or after a certain number of years. Things to think about too. If it is the case where your investor is maybe your brewmaster, it's an employee, what happens if they stop providing services? What happens if you have a disagreement about where the company should go? What happens then? Can they still vote? Do they have to sell their shares back? How much control do they still have? What happens and these are all hard conversations to have, particularly if your investor is somebody it's people in your community, it's family, it's friends. But you have to have these hard conversations up front to avoid problems down the line. Make sure everybody's on the same page as to what rights this new investor has, how much control they have, what happens if you disagree, what happens if they die, what happens if they become disabled, what happens if they get sued or they file for bankruptcy. These are all the hard conversations, but it's very important to have them up front, because if you don't, then unfortunately is when we have problems down the road. Now this one's important, particularly if we're doing something like a private placement or a private tender offer, where we're just bringing in a few folks and maybe they're going to have a nice chunk, for lack of a better term, of your business. Are they prohibited persons? Are they people that are going to be a problem for purposes of the TTB or the SLA? Are they under 21? Are they not U.S. citizens or permanent legal residents? Police officers or police officials? Do they have any criminal convictions we need to worry about, particularly felonies? And this is the big one, the last one. Do they have any ownership interest in a retail liquor license? I have had this come up a lot, particularly with the rise of the craft beverage industry. It's happened a lot where I've had clients say, I really want to partner with so-and-so. I'm really into, I love their beer. I'm interested. I think they've got such a great thing going. I want to invest. I want to be in it. Oh, but I also invested in a hotel. I also have a restaurant. And then we have problems. You've probably heard about the New York State Liquor Authority's, the tied house rules. Another rule that goes back to the 30s that causes problems now because it doesn't necessarily reflect the way business is in 2021, but it's still on the books and we still have to worry about it. So we've got new investors. We're thinking about bringing in new investors. Maybe we know who they are. Do we have to tell the TTB and the Liquor Authority, right? How much are they going to own? Do we have to tell them? So for the TTB's perspective, it's going to make a difference whether your business is a corporation or an LLC. I've always thought it shouldn't, but the way the law is written, it does. So under these regs, if you have the TTB regs, if you have a change in ownership, when do you have to report it to the TTB? So the TTB says, if you, in the event of a change in the ownership, management, or control of your entity, you have to report it. In the case of a corporation, any change in the officers, directors, or persons holding more than 10% of the corporate stock. Okay. There's no similar limitation in the law for LLCs. So if you add a new member to your LLC, even if they're only going to own 5%, under the law, under these regulations, you'd have to tell the TTB. But if you were a corporation and you sold somebody 5% and you still own the rest, you might not have to report it. So it makes a difference. Are you going to need to report the investment to the SLA? You're probably familiar with these. Generally speaking, if you have more than 10 owners, then we worry about whether they own more than 10% or not. But if you tell me you've only got 2 owners right now, and you're going to bring in a third, a fourth, a fifth, and a sixth, and each one of them are going to own 5%, you still have to tell the Liquor Authority because you don't have more than 10. You don't have more than 10, so you're going to have to report the change. You're also going to have to report the change for any of these if the folks coming in are going to have an officer role or a director role. So working through the transaction, we're just about to the end. I will say this, in any of these, get your tax and financial advisors involved early. Definitely get them involved early on. It will save you so many headaches down the road. You'll want to plan also for fees. Portals have fees. There's accounting, your accountant's going to have to put together things for you. That's going to be fees. There may be legal fees. Keep that in mind as you decide how much you think you need to bring in. Accounting for timing. You know, none of these are tremendously fast. You know, obviously everybody work with you to get it as fast as we can, but it's something to think about. Make sure you have enough time. And papering the deal. It seems, I've heard that a lot, like, oh, we just need to paper it. We know exactly what we want to do. You just need to paper it. But the paper is important, particularly to make sure you don't have problems down the road with the folks you're bringing in. And then once you've got your investors in, make sure you follow through with everything the way you're supposed to have done. If they are entitled to be appointed to the board of directors, have they been? Are you holding those shareholder meetings if you promised them you were going to do that? Those kinds of things. And if they are going to be having any day-to-day responsibilities, have an agreement in place for that as well, an employment or services agreement. And you, as the current owner, may want to have an agreement too to protect your income. If you're providing day-to-day services, are you drawing a salary? How is that going to be done? So also something to think about. So in conclusion, many different reasons that you may want to bring in investors, and there's many different ways to do it. Each has its own difficulties, each has its own benefits, and be aware of the liquor licensing aspects of the transaction early on. And there we go. I put my contact information there at the end. Happy to answer obviously happy to answer any questions right now. But if there's something you want to talk about offline, that's the way to get me as well.
Thanks, Jennifer. We've got about 5 minutes left. Ethan, go ahead with your question.
Yeah, I just wondered if there were any review sites for crowdsourcing portals. Like, they can't all be as good as one another. Some of them, I'm sure, are crap, and others maybe have a pretty high success rate or whatever.
Right.
So is there any way to evaluate, these portals themselves?
Right. I don't know that there's at least I haven't seen a good website out there that kind of pulls it all together. I've looked into some and just read some reviews out there, but I'm not aware of there being a site that pulls it all together for you. There may be, but I haven't come across it.
Steve Blank, go ahead.
Hi, great presentation. I came across an opportunity to buy a beer distributor that has a C103 license, but I'm also in the process of starting my own brewery. When I spoke to the SLA, they said I can own both licenses, being that I guess it's a grandfathered license to allow you to own both, but I don't think we're on the same page. Have you heard anything about the C103 license and being able to own a brewery?
Yes. I haven't discussed that specifically, but they do consider that C103 license to fall within the wholesale type, right? So it is this strange hybrid license that I don't think they've issued since the 60s, but you can buy them, right? So it does fall, they do consider that a wholesale license. So it would make sense to me that they would be okay with you having both a brewery and a C103.
Okay, perfect.
It would make sense to me, but I have not specifically discussed that with them, but I can see why that would be okay.
Awesome. Thank you so much.
No problem.
Any last questions before we wrap up? If not, I guess one question I like to ask Jennifer is, what are some of the most, what is the most common mistake that somebody would make when bringing in an investor, that has really caused issues with them that you can share?
Right. I would say the two I've seen the most, one is getting really far down the road with an investor until you're ready to go and they're ready to write you a check before you talk to your financial folks or your legal, your legal advisors. And then we have to tell you, I'm so glad they're going to write you a check tomorrow, but there's a problem. That's one. And the other one is not talking about the hard stuff up front. And then you have a breakdown in the relationship at some point, not being clear on what their rights, the investors' rights are to have a vote, and what happens if you don't all agree going forward. I'd say those are the two. And you see it a lot in families. I think any of us who do these kind of transactions, not necessarily for business with liquor license, but any small businesses, the breakdowns that can happen when folks are either friends or families, it can happen, and it can get really emotional. It can be problematic. And I find it's much better if you ask those really hard, uncomfortable questions up front. And then you kind of know what everybody's rights and responsibilities are going forward.
And same with real quick with crowdfunding. What are some of the big mistakes or things that people should really worry about or think about?
Right. I think just to make people aware that there's still a lot to it. I think people who've maybe donated or gone through Kickstarter and, oh, that was easy. I just did PayPal a little bit, and why do I have to do all these other things? Because it is regulation crowdfunding, because you're selling part of your business. You still have to, there's still a lot of hoops to jump through.
Great. Thank you so much, Jennifer, for your time and presentation today. It was a lot of great information. Thank you all for joining us. In the chat, you'll see, this is recorded. It will be on our YouTube channel, so please subscribe and also look at the full schedule. Up next is Accounting Recovery After the Pandemic, which will start at 2:30, which is also in the chat. So Jennifer, your information is there as well. So please feel free to reach out to Jennifer directly if you all have questions.
Absolutely. Thank you, everyone.
Thanks, Jennifer. Thanks, everybody.
Have a good day.